Welcome to the Train to Invest Education Seminar. Today's topic is about wealth management. We are delighted to have you here today as we come together to explore strategies that can help us build, protect, and sustain financial well-being. This seminar is designed to provide practical insights into investing and ancillary tools to navigate today's financial landscape with confidence. We encourage you to hold your questions to the end of the seminar and make the most of the information that is being presented. What is wealth? Unfortunately, most individuals and families have no idea of what wealth is. Wealth is not about money alone. It is about people, relationships, doing good, and certainly about family. Wealth is a gift. It needs to be safeguarded, nurtured, and shared productively for the benefits of family and others. Each family and every individual has their own values and unique circumstances relating to managing their own wealth. It provides financial security, enables long-term planning, and is a key measure of stability and prosperity, both for individuals and societies. Who taught you about wealth management? Did you learn from your school, or your friends, or your parents, or your grandparents, or seminars you attended, or from books that you read, or from colleges or universities that you attended? Children are influenced by their parents' views on many matters. If parents complain about living from paycheck to paycheck, guess what? The children will mimic that message. Same with foul language or with political affiliation, etc. Your knowledge about wealth management is learnt through osmosis, that is, from a combination of many inputs. Very few people pursue wealth management through a systematic study. The challenge. Tradition. There is an assumption that if you studied accounting, finance, business, etc., you would have learned to be wealthy. Wrong. You studied about wealth management, but you have been trained to get a job, that is, working for someone else. It is possible that over a long period of time you may become wealthy. Unfortunately, most people learn about money and wealth management from their families. Traditions that are passed down from generation to generation. The problem with that is when two traditions meet. When two people get married, they bring different money traditions. One may be a spender, the other a saver. One may avoid risk, the other may embrace it. These differences can cause conflict. They fail to understand risk profiles.
What is risk profile? It is the inherent traits that you were born with, an ability to handle different levels of risks. For example, in the case of a married couple, 1. The husband has an entrepreneurial background, while the wife has a civil servant mindset. Her focus is on pensions, etc. 2. The husband has a higher risk level. For example, he likes to trade in cryptocurrency. The wife, on the other hand, has a lower risk level. She prefers fixed returns, such as a GIC. 3. For the husband, going on a vacation means flying to Hawaii. For the wife, going on a vacation means visiting relatives nearby. 4. For the husband, camping means staying at a 5-star hotel, but the wife prefers staying in a tent. They have very different risk profiles, but they got married. Risk tolerance is your risk level comfort. Usually, the one with a higher risk tolerance, husband or wife, would have attempted to build wealth through several ways. But before we look at those options, let us focus on the picture below. Which apple will you pick? The choices of picking the apples in the picture. The nearest apple, which is the smallest, is the easiest to pick. It is likely the one that the wife chooses, based on her risk profile. The furthest apple, which is much bigger, is harder to pick. It is likely the one that the husband will choose, based on his risk profile. But unfortunately, we have some types, who we term gunslingers, who would say, "Back up the truck. We will take the whole tree." Who is right? They all reacted based on their risk profiles.
Neither decision is wrong. It depends on a person's risk tolerance, a concept that most families do not understand. A person is wired, actually created that way, and there is nothing we can do to change them. Example: if a person is a morning person, you cannot change that. Any attempt to force a behavior change, usually through manipulation, sarcasm, public humiliation, mind games, etc., will result in frustration, bitterness, anger, distrust, eventually ending in divorce. Why? Because money is usually the ultimate security blanket that most individuals hang on to. In fact, it becomes their God as they increase in age. Planning for old age is good. Becoming obsessed about your future is a disease.
Delegating responsibility. A great sense of fear. Many people are extremely successful in their businesses, the jobs, in their professions, etc. But a great sense of fear overtakes them when it comes to managing wealth. Why? 1. Spouses have no confidence in the other spouse's money management skills. 2. The objecting spouse usually has no clue what to do either, so they turn over their hard-earned savings to outside experts. Question: how did they pick these experts? Trial and error methods. 90% of wealth management attempts by families are through trial and error methods. 1. Mutual funds. You never meet the portfolio manager who actually does the trading. All you meet are sales personnel, called financial advisors. This is misleading marketing. 2. Multi-level and network marketing. This unfortunately ends up in selling soap to family members to meet the quotas that are given. 3. Real estate. This is an expensive, over-leveraged attempt at wealth building. Speculation usually creates a seller's market resulting in huge losses. 4. Franchises. A very expensive job. A huge amount of fees is paid to the franchising company. 5. Others. Black box programs that trade penny stocks. Forex. Option trading, etc. This is actually gambling guided through software algorithms. 6. Stock investing. Let's discuss this. What about the stock market? At the very mention of the stock market, a great sense of fear overtakes them. As seen the picture, what causes this fear? A. Ignorance. B. False information. C. Myths. What is the challenge? What prevents the average person from taking advantage of stock market investments? 1. Fear. Attempting things that society deems impossible, for numerous reasons. 2. Greed. Instant gratification. That is, a get-rich-quick mindset. 3. The rapid pace of change. Not understanding that technological advances takes place every few years. Most understand fear and greed, but have no clue about the rapid pace of technological change. Rapid pace of change. Telephones. Look at the rotary telephone and the latest iPhone. A. It took more than a century to get 1 billion people to have telephones. B. The second billion only took 5 years. C. By the end of this decade, 4 billion people will own phones with built-in artificial intelligence capabilities. That is, 4 billion people will have access to the global economy. Rapid pace of change. Flights. Companies get rewarded for innovation, ability to market new technologies, etc. Change. That is the main challenge that faces human beings. In 1903, the Wright brothers made the world's first flight. In 1969, man landed on the moon. See the picture. In 66 years, one generation, what technological advances must have taken place for that to happen? Misinformation and myths. You may have heard of stories like Bob's cousin made a killing buying XYZ company based on a hot tip. Or, watch out with stock trading. You can lose your shirt in a matter of days. That kind of misinformation is based on a get-rich-quick mindset. Stock investment can create massive amount of wealth, but they are not without risks. That is why it is important to have education that can mitigate those risks. Most people have no idea about what the stock market is. They assume that it is A. a form of gambling. B. You need a PhD to understand stock investment. Let us look at some basic rules in this program. A. Building individual skill sets. Your ability to correctly read and interpret charts and technical indicators will give you the ability to make profits. B. Understand your risk profile, that is, your ability to tolerate losses. For example, some are able to take a $1,000 loss on a trade, but others will be decimated at such a loss. C. Time frame. Understand the type of trade that you are entering. Is it a 14-day short-term trade or a 12-month investment? You need to calculate the following before execution of a trade. 1. A buy price. 2. A sell price. 3. A stop loss or exit price. Having done the above prior execution provides a disciplined strategy without surprises. The TRAIN2INVEST program and strategy. The 3 areas that we teach that mitigates the risk in stock trading. Emotional analysis, removing the fear and greed. Emotional challenges faced in trading stocks through a disciplined approach. Fundamental analysis. Portfolio building. Buy quality companies. You are shown how to do this. You will be given 5 companies to start building your portfolio immediately. Technical analysis. You are taught how to use technical indicators to execute entry and exit strategies. Dealing with emotional challenges. A mathematical solution. Fear and greed. There are those who are gunslingers with a mindset saying, "Let's go all in," looking to hit a home run. These are often struck out almost immediately. Then, there are those who, like a deer stuck in the headlight mindset, who procrastinate looking for the perfect opportunity. They never get off the starting block. The solution is using a mathematical formula called the CPR strategy to limit downside risk and control emotions, where C equals amount of capital, P equals position size, and R equals risk per share. This is a disciplined mathematical approach that will eliminate anxiety and provide an assumed number of shares to purchase. Fundamental analysis. The economy. The primary focus will be on 2 areas. 1. The global and domestic economy, and 2. Building a portfolio of 10 names. Looking at Chart 1, the Canadian economy is approximately 2.5 trillion Canadian dollars. Looking at Chart 2, the Canadian stock market grew by 76% since the COVID meltdown in 2020. Obviously, as the economy grows, it shows that companies are profitable. That increases the value of the stock market as a whole. What amount of research must you do? Nothing much, as we provide updated data via our blog. Fundamental analysis. Research. As you see from the charts below, our updated blog provides recent and relevant data for your consumption. On top of that, you will receive a monthly newsletter, first of each month, a monthly Coach's Corner bulletin, mid-month, and a weekly real-time market analysis. You are not alone. You have help all the way. There are even stock suggestions as dictated by the market movements. These suggestions carry a suggested buy price, a sell price, and an exit price. Our track record has been phenomenal, approximately 87%. We will provide you with a portfolio called the Focus 5 to begin your investing education. Fundamental analysis. Portfolio analysis. Let's look at the Focus 5 portfolio. It consists of Suncor Energy, Enbridge Incorporated, Imperial Oil Company, the Royal Bank, and TD Bank. Chart highlights the market capitalization, total asset value, annual dividend, years of dividend payments, annual profits, and annual revenue. Most of these figures are shown in Canadian dollars billions. As you can see, the smallest by market capitalization is Imperial Oil, valued at 46 billion Canadian dollars, and the largest being the Royal Bank, valued at 283 billion Canadian dollars. The chart below the Focus 5 shows the analysts' recent forecasts and recommendations as to why one should buy into these companies. The Focus 5 companies are one of the most profitable companies in the top 50 TSX companies. These companies have a track record of paying dividends from over 25 years to 100 years. Fundamental analysis. Track record. If 5 years ago, January 2020, you bought 100 shares of each of these Focus 5 names, what kind of return would you have if you sold all the shares today? August 2025. The total gains, capital appreciation plus dividend income, would be Suncor $2,643, Enbridge $3,882, Imperial Oil $11,113, Royal Bank $12,851, and TD Bank $5,355. The total would be $35,844, or an ROI of 54%. That would be an awesome track record. Technical analysis. Charting. This is a 6-month daily chart for the Royal Bank. Stock symbol RY.TO. It shows A. The top screen, the daily share price bars, red and green, and B. The bottom screen, the MACD technical indicator. This indicator has signal line, red, the MACD line, blue, and the histogram bars. Let's look for MACD line and signal line crosses to locate entry or exit points. Technical analysis. MACD technical indicator rules. Buy signal. When the blue MACD line crosses above the red signal line, it suggests a buy signal. Sell signal. When the blue MACD line crosses below the red signal line, it suggests a sell signal. As you can see from this chart, there are 8 crosses. Technical analysis. MACD buy and sell crossovers. Blue arrow is a buy. Red arrow is a sell. Point A shows a MACD crossover, buy, number 1, and sell, number 2. Point B shows a MACD crossover, buy, number 3, and sell, number 4. Point C shows a MACD crossover, buy, number 5, and sell, number 6. Point D shows a MACD crossover, buy, number 7, and sell, number 8. The next slide will show the computation. Technical analysis. MACD crossover trades. Letter A, March 13th, buy $157. March 25th, sell $167, gain $10. Letter B, April 9, buy $153. April 23rd, sell $165, gain $12. Letter C, June 26, buy $176. July 21, sell $182, gain $6. Letter D, August 12, buy $184.50. August 27th, sell $204.50, gain $20. Summary: 100 shares at $48 per share equals $4,800. Return on investment equals 7%. Technical analysis. 1,000 shares. Assuming 1,000 shares were acquired, at $48 gain equals $51,000, includes $3,000 in dividend income. On average, it was 17 days that generated 7%. Myths associated with the stock market. Investing is a form of gambling. Ownership versus chance. When investing, you buy ownership in real assets like companies, bonds, or real estate that generate income or appreciate in value. Gambling is purely betting on uncertain outcomes with no ownership or productive value. Wealth building. Investing builds wealth gradually through compound growth, dividends, and capital appreciation. Gambling seeks quick wins and thrills, often resulting in losses over time. Myths associated with the stock market. The stock market is very risky. Everything that we do involves some risk. However, where there is risk, we have an ability to mitigate that risk. Example: for marriages, the risk is divorce. The mitigating factor would be counseling. For driving, the risk is accidents. The mitigating factor would be insurance. For car ownership, the risk is that it would turn out to be a lemon. The mitigating factor would be warranty protection. For traveling, the risk is flight cancellation. The mitigating factor would be to buy cancellation insurance. For investments, there is a risk that the company may face bankruptcy. The mitigating factor would be diversification. While we cannot guarantee 100% protection against any kind of risks that we face daily, there is an ability to seek mitigating factors. While the downside is somewhat protected, we look to the great upside in return on investments. Myths associated with the stock market. Cash is king. A much safer option. Inflation kills the value of money. The value of your savings will be quickly depleted in the face of inflation. Today, you get 1.5% per year for fixed deposits, with inflation running at 7+%. This means the increase in the cost of goods significantly outpaces the savings rate. The value of your assets would likely decrease each year. The rule of 72. Compound interest. 72 divided by a rate of return. This will give you the time it would take for that investment to double in years. For example, return. At 3% interest, the investment will double in 24 years. 72 divided by 3. Inflation. If inflation rates go up from 2% to 4%, your investment will lose 50% of its value in 18 years. 72 divided by 4. Myths associated with the stock market. You need a PhD to understand investments. This is the myth propagated by the financial services industry, an industry which is protected by politicians. Who supports their election campaigns? May this be a clue. The ability to make you think that you need experts to do it for you implies that you are not too smart. The investing language that they use on you is to create doubt about your ability to do it yourself, which creates fear about your skill set. The fee income structure is a huge incentive for them to do it for you. Fact. Anyone who has the knowledge and the discipline can invest in the stock market with confidence and consistency. Myths associated with the stock market. Massive capital required. The failure to understand that every Canadian who has any segregated account, such as an RRSP account, is already invested in the stock market, usually through mutual funds. You could open an account with just $50. Myths associated with the stock market. Zero-sum game. Assumption of this theory is that when one investor loses money on a stock, someone else has gained that money, implying that there is a fixed number of shares in the market. Example: ABC Company is in the oil business. It discovered an opportunity to drill in Alaska. It requires a special rig, which will cost $1.5 billion due to the weather conditions. How would ABC Company fund this cost? Internal cash, $0.25 billion. Bank funds, bonds, $0.25 billion. Equity market, $1 billion. Total, $1.5 billion. ABC Company will issue shares in the market to raise the $1 billion it needs. Banks, mutual funds, pension funds, and insurance companies will buy its shares in the hopes, based on their analysis, that it would be worth more after the drilling begins. As these are new shares, the zero-sum theory is false. Stock market crashes and recoveries. Let us review recent stock market crashes that is often cited by the ignorant who claim that you could lose your shirt. There were 3 recent crashes, namely the financial crash of 2008, the COVID crash of 2020, and the interest rate and recession fear crash of 2022. Looking at the chart, you can see that the 2008 crash recovered by 2015, with a gain of 105%. The 2020 crash recovered by 2022, with a gain of 89%, and the 2022 crash recovered by 2025, with a gain of 56%. Here is something to think about. Did the Royal Bank collapse during these recessions? Of course not. It still continues to trade to this day. Stock market crashes and recoveries. Focus 5 names. Let us review the stock performance of the Focus 5 companies during these 3 stock market crashes. Remember, the Focus 5 companies are Suncor, Enbridge, Imperial Oil, the Royal Bank, and TD Bank. Looking at the chart, you will note that the stocks of all these 5 companies dipped when the crashes took place. However, they all subsequently recovered as the stock market itself recovered. In fact, you can see the tremendous surge in the 5 stock prices as at September 2025. The companies that collapsed were those penny stocks. Education defeats risks. Long-term strategy. January 2020 to September 2025. You say you are very busy and do not have any time. We will help you structure a buy and look strategy. Looking at the chart, during the COVID market crash of 2020, we bought shares of the Focus 5 companies. Our total cost was $30,000 in our RRSP and TFSA accounts each. We sold these shares on September 5, 2025, as the TSX hit a record high. The capital gains for the 5 companies was $44,075. The dividend income that was generated during that time frame amounted to $10,201. The combined total amounted to $54,276 in gains, or ROI, of 182%. So both our RRSP account and TFSA account grew by 182% each. That's how you build wealth. How do you retire early? In addition to any other income that you may have, would an additional annual income of $52,000 per year help in you seeking early retirement? Let's look at the chart. Chart 1 is the husband's TFSA account. Chart 2 is the joint RRSP account. Assumptions. A. You will contribute $5,000 each to both accounts annually. B. It is assumed that you have $20,000 in the TFSA account and $120,000 in the RRSP account. C. You could generate 20% per year consistently over the next 10 years. On year 10, your TFSA account would generate $19,000, while your RRSP account will generate $33,000. Total income, $52,000. That's how you retire early. Question. Can you make 20% per year? Looking at the 2-year weekly chart of the Royal Bank. Number 1, October 30, 2023, bought 500 shares at $100 per share. Number 2, 2024, sold 500 shares at $180 per share. The capital gains per share was $80. Dividend income. There were 4 amounts of $1.42 of dividend income that was recorded, totaling $5.68 per share. The total gain per share equals $80 plus $5.68 equals $85.68. For the 500 shares, it will be 500 times $85.68. 85.68 equals $42,840. That is 86% return. Therefore, a 20% annual return is quite achievable. Skeptics claim that a 20% ROI cannot be achieved as the experts have not been able to do this. Let's look at this actual copy of a bank statement from TD Bank. The time period shown is from March 27, 2020 to February 4, 2021, about 12 months. The results. For this past year, the return generated was 38.96%. For the last 3 years, the return generated was 1,024.82%. For the last 5 years, the return generated was 852.91%. This is concrete proof that a 20% annual return is very possible. Therefore, the evidence submitted demands a verdict. Testimony. October 2021. Looking at a client's actual statement from TD Bank, it shows a return of 655.64% return over 5 years. The email dated October 20th, 2021 at 10:06 a.m. reads as follows. Attached is a copy of my trading account. Since I retired from work in November of 2017, I have been able to focus more on my investments and have done fairly well. I still mess up occasionally, that is, fear and greed. I feel very fortunate to have done as well as I have. None of this would have happened if I had not taken the TRAIN2INVEST course. I am very grateful. The evidence demands a verdict.
Testimony. July 11, 2023. The email reads as follows. Just a short note to give you an update on my track record. I joined TRAIN2INVEST around 2018. I must say it has been a journey that surprised me, especially my wife. We averaged about 25% per year. Even during the COVID meltdown, we got up to 8% before the market took off, as you had predicted. I just want to thank you and your team for such a wonderful job you guys have done in making it so simple for a potato farmer with a grade 9 education. I have been able to get my kids into the program and am blessed to see them take up the challenge. As you have pointed out, my dyslexic son, Junior, as you show, has done fabulously. I could not imagine this boy's determination to set targets and achieve them. Thank you very much and God bless you all. P.S. You can share this testimony if you block the email address. Testimony. July 28, 2023. Junior's track record. As the previous email talked about Junior's performance, the TD Bank statement shows the details. Junior trades with a capital amount of around $5,700. The statement shows the trading result for 1 month, June 28, 2023 to July 28, 2023. The record shows that he achieved a 14.4% ROI in 1 month. The evidence demands a verdict. Testimony. August 14, 2023. From a stay-at-home mom to a savvy trader. The email reads as follows. Thanks for all your help over the last couple of years. You turned a stay-at-home mom into a savvy trader. I came from a very limited financial knowledge base where I trusted an advisor with all my funds to confidently managing my accounts. I am confident that without the support of Train2Invest, I would not be where I am today financially. Here's a screenshot of my accounts. The screenshot shows that she achieved 93.95% for the last 3 years. Testimony. June 29th, 2024. Track record. From January 2024 to June 2024. The email reads as follows. I have had a great 6 months with our portfolio. I started with Train2Invest sometime in 2015. There were some up and down years, but overall, I think our portfolio increased by 22%. We are ranchers in Alberta, and were somewhat depressed with our financial planner in 2015. By recommendation of a cousin, we signed up. This was probably the smartest move that we made. Our return for this 6-month period was 29% for our overall portfolio. Testimony. November 12, 2024. Client for more than 18 years. The email reads as follows. My husband earned 37% on his trading account, and I earned 28% and 24% on both of mine year to date. We absolutely love that we can generate income beyond our regular day jobs. It can be a challenge to watch stocks as much as we would like with running a busy household, but the fundamentals and technical training we learned with Train2Invest have allowed us to earn money despite that. We took the course 18 years ago and never looked back. We are so glad that we did. P.S. Please be sure to keep our names confidential. Testimony. May 20th, 2025. Made over $1 million. The email reads as follows. I want to thank Jonathan and company for getting me interested in the market and things like MACD, RSI and stochastics, etc. Thanks to Jonathan in particular for the things he taught us about the market. We have now made over $1 million in the market, and our portfolio is roughly double that. Thanks. Testimony. June 17, 2025. Over 15 years with Train2Invest. The email reads as follows. 2024. January 2nd to May 31st. Profit. $82,190 ROI. 16.78%. 2025. January 2 to May 31. Profit. $48,322.00. ROI. 14.5%. Testimony. August 26, 2025. Over 19 years with Train2Invest. The email reads as follows. Sorry for the delay in responding to your request for a portfolio update. I became a grandmother for the 6th time on July 27th. I started investing around 2006 and have seen my portfolio grow significantly, at least 1,500% or more. All my family members, including my 2 children, have taken the investment course and done well. Thank you and your teams for such great patience. James passed in 2020 from COVID. I have continued trading and have done well. Here's my portfolio update from January 2025 to August 2025. Cash account, up 35%. TFSA account, up 27%. Investment account, up 33%. Name redacted. Train2Invest. Background. Established in 2004, Train2Invest has trained thousands of individuals. Not one complaint or bad review. Search Google. Our philosophy. Pursue small, consistent gains following a strategic investment plan. Strategy. Teach, train, and coach. No 2 people learn the same way. A student-centered approach delivers a step-by-step learning process that breaks down complex subject matter into bite-sized pieces. The classes can be repeated as often as necessary for 1 year. For further information, go to www.train2invest.com. The Train2Invest Education Course. Primarily, there are 3 phases to the course. Phase 1, Teaching. Phase 2, Training. Phase 3, Coaching. It is divided into 3 categories. 1. Fundamental Analysis, the Science of Investing. 2. Technical Analysis, the Art of Investing. 3. Emotional Analysis, the Risk Management. The average novice trader graduates from dummy account trading to actual trading within 3 to 6 months, depending on the individual's skill set. The Train2Invest Education Course. Basic details. There are 10 basic modules which are recorded. These come with PDF notes as a complement to the classes. In addition, the student will receive A. Every Sunday night, a recording called Real-Time Market Analysis, which highlights the events for the following week. B. Every first of the month, a monthly newsletter, which highlights global and domestic economic and geopolitical events. C. Every mid-month, a Coach's Corner bulletin will be sent, highlighting technical analysis of sectors and specific stocks. On successful completion, the student can review advanced investment sessions. What % return are you currently getting? Mutual fund performances. The average annualized return for Canadian equity mutual funds for the 5-year period ending in mid-2025 was approximately 8%. For Canadian equity mutual funds sold with embedded advisory fees, Series A, the average MER for the period has been in the range of 2.00% to 2.20%. Morningstar analysis. According to official data from Statistics Canada, the annual average inflation rate in Canada for the calendar year 2024 was 3.9%. Mutual fund return 8%. Less MER cost minus 2%. Less inflation minus 4%. Actual return 2%. Note: A. 1-year GIC. The average rate is around 3.30% to 3.50%. B. Royal Bank annual dividend, $6.16 per share. Yield, 3.05%. Let us do the math. Mutual fund performances. Looking at the chart, assume that you had $50,000 in your RRSP account and that your mutual fund paid a net return of 8% per year. Gross 10% less MER. Cost 2%. Compare that with a self-directed trading strategy, which generates 20% per year. At the end of 10 years, the self-directed account would have turned the $50,000 initial capital into $309,635.92, or 520%. The mutual fund would generate $106,950.90, or 113%. You paid in fees $15,135.85, or 30%. If you invested that $15,100 at 20% a year, you would have generated approximately an additional $79,000. That is how the rich build wealth. The cost of the program. Let us deal with the concept of value. Looking at the chart, A. They are both cars that take you from point A to point B. B. Which of these cars costs more than $100,000? C. Which car will likely protect you in an accident with a Mack truck? In order to compare the cost of this program with your existing returns, 1. Firstly, calculate the cost that you are currently paying in fees for the return that you are getting. 2. Secondly, what is the return you are getting? Does it at least beat inflation? In order to review your financial needs and how this program can meet those needs, please call 1-204-414-99106, voicemail, and leave a callback number, or email admin@train2invest.com, giving a day and time that is best to discuss this program. Thank you for listening to this presentation. If you have any questions, please email admin@train2invest.com.